So the big tax question is this: how do wealthy people keep their money working for them when selling their business, real estate, or other highly appreciated assets without paying hundreds of thousands to millions of dollars in tax? What if we, as business and real estate owners who have poured blood, sweat, and tears to growing our wealth, and who didn't hire expensive tax attorneys and CPAs to map out an exit strategy, knew their secrets? Instead of recreating the wheel, why can't we just model the way they deferred 30 to 50% in tax, paid off debt, funded their next business dream, and most importantly, leave a financial legacy to give to the causes we believe in most? What if their secrets weren't complicated at all, and you just need a guide who is a few steps ahead of you? That is the question, and this podcast will give you the answers. My name is Brett Swartz, and welcome to Capital Gains Tax Solutions. Welcome to the Build to Billions podcast, where we guide successful entrepreneurs and investors on their journey from millions to billions. We believe the key to scaling and compounding your wealth and life starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal is to help you scale and compound your wealth and life so you can give more all over the way to help MVPs. My name is Brett Swartz. Each and every episode, we're joined by the world's top entrepreneurs, millionaires, or billionaires, and they share their secrets, wisdom, and insights with us so we can all level up and make a bigger impact. I'm excited about our next guest. He is focused on like a laser and helping us to keep more of what we've earned. He entered the financial advising business after serving the U.S. Army, and during that time, he watched his two younger brothers build their career as investment advisors, and being able to capitalize on their experiences allowed him to identify early on what kind of firm he wanted to be a part of. And he is licensed in Series 7, 66, Life and Health, and he is now helping people build wealth in a meaningful way with OFly. We'll talk a bit more about that and his new book, Keep What You've Earned. Please welcome to the show with me, Elliot Omanson. Make sure I pronounce that last name, Elliot, correctly again, because I know it's a little bit tongue-twister.
Omanson, but everybody says Omanson, so it's totally fine.
Oh, Manson. Yeah, there it is. I gotta really pronunciate that O. For our listeners, get to know you for the first time, Elliot. Could you give us a little bit more about your story and your focus?
Yeah. Obviously, I haven't always been here, right? And one of the things that I like to go a little bit further back than most people probably care about, but I was in a podcast and somebody asked, well, how did both your brothers and you all end up in this as financial advisors, right? Clearly your parents did something wrong, but I'd never really thought of it before, and at that time, the memory that came back to me was being 10 years old, coming over my first job babysitting, and it's the 80s, so there was no bicycle helmets, airbags, it was a little bit different of a time. But my mom was waiting for me with a 3x5 spiral bound note card book, and she had me make columns in it. And one was who I worked for, the date I worked for them, how much they paid me. And then I had to put 10% to tithing, 50% to my savings account, and 40%, my favorite column, right, spending. And by the time I was 15, I think I had probably like $5,000 saved up in my bank account. And then she sat me down with a family investment advisor in my kitchen. And, it was kind of funny. It took me like 20 minutes to get this guy she sat us down and she went to teach piano. And it took me like 20 minutes to get him to stop talking about how hot he thought my mom was. So he could actually focus on business. And I made my first investments, right? And then at 17, I sold the first time I ever sold out something to use for myself, and went to Europe for the summer with some friends. And so by the time I was 17 years old, I'd already gone through this whole life cycle of working, earning, saving, investing, and realizing a gain on my investment. All at the hands of my mother, right? How many people get that, right? So, it's not surprising, all three of us, when you're raised by a woman like that, all three of you end up in the money business, right? So
I love it. That's really cool. What an awesome mom. What a great story. And to take advantage of for my kids to be really care. We doing the rich dad, poor dad cash flow quadrant game.
Yeah, we have that.
Yeah, we're working through and like, what does that mean to get out of the rat race and how did that look? Yep. And so, but no, I think that's great. Like writing it down. That notebook, did you keep it for a long time or where's the notebook now?
I have no idea. I wish I had, because I think that'd be a really neat artifact from my past to have hung on to. Now, what's funny about it is at the same time I had all that going for me, I was also a total screw up in school. I hated school. I was arrested and thrown out of high school. Never went to college. And by the time I was 30, I was like really struggling. Like I was married. I had 2 kids. I think I was in the middle of being evicted for the 3rd time. I didn't have a car. It was repoed. Like, you know, so even though your parents did this really good job giving you this foundation, you can still screw it up. And I'd always wanted to join the military. I'd even tried earlier, but my wife didn't really want to be married to a guy in the Army. But by the time I was 30, I was like, I didn't know what else to do. And I felt like I had 90% of what I needed. I was just missing something. And I was driving down the road in a rental and looked over and saw an armed forces recruitment place. And this was at the height of U.S. combat casualties in Iraq. It was the end. It was like August of 2006 when I started this process. And so I just pulled in and enlisted. Didn't even tell my wife. Like, and it's a really morbid mindset, but I figured either A, I go to war and get killed and she gets a life insurance check, or B, I earn a check every month and pay my bills, right? Like I just was at a loss as to what else to do. And, you know, and it's funny because everybody always assumes that having been in the military, the thing I was missing, the thing that I gained from it, they always assume it's discipline. And that was not what I got. I was very fortunate to go into a line of work in the Army that's perfect for my personality type. And discipline's not a part of it.
What was the line? What was the line in Army?
What was the what?
What was the spot in the Army that you went into?
It's what's called a forward observer, 13
Okay.
Fox. We operate forward of the military, unsupported in hostile territory.
Okay.
At one point, I ended up as what's called a COLT chief, a combat observation lasing team chief. And it's the smallest team in the military, and it operates with no officer. And in order to really be good in that role, it requires very independent people, right? And so the military actually really kind of makes no attempt to rein you in. They need you to be capable of like all your own thought and action and whatnot. And that was perfect for me. But I think the thing that I gained from it was a completely different view of risk than what the average person carries with them, right? And so I always talk about, and risk's so important in investing. It's so important in being an entrepreneur. And I think entrepreneurs understand this concept of risk, right? I always believe at the very top, there's 2 types of risk: inaction or action. And so many people think action equates to risk, but any entrepreneur knows it's the opposite, right? But guess who believes action equates to risk? Your attorney, your CPA, right? You know, I refer to those people as your team of no. And one of the things I write about in my book, Keep What You've Earned, is how there's a lack of incentive. In fact, there is a incentive for them to always tell you no. They don't want to take responsibility. They don't want to take on the extra work. I don't even think they know how to structure their revenue and their fees correctly to even warrant being an actual tax strategist on behalf of their clients. And so it's so much easier for them just to do the status quo, file tax returns, and just tell you, hey, this is just...
You're preaching to the choir. It's the number one thing that's probably is the most painful if we lose an opportunity to help someone who's exiting, right? I imagine it's the same with you, where it's this fear of this other CPA, other brother-in-law, other financial advisor, or whoever, broker, who just says, I don't know if I would do it. And it's like, it's so easy for them to say that, right?
Yeah.
It's not their money, right? Number one. Number two, you're letting fear, false evidence appears real, like, make this big, a lot of times we're helping people that are actually multi-million-dollar assets, right? This huge decision that has the effect of momentum for your wealth and your legacy, despite the evidence of, let's say, one of the strategies we'll talk about has, 1,000+ transactions, then through all the audits, all the things. But that's the worst one to lose. Like, I don't mind if someone says, hey, I just can't, I don't necessarily, I don't like the fees, or I don't like the giving up too much control, or I don't like those things I can understand. But when they I like everything about it and it's going to be a perfect fit, but I'm just gripped by this fear, or the boogie tax man, he's going to come and pay it, and my advisor just gave me enough skepticism. And the worst is they won't get on the call to get into the arena, if you will, to have a nice discussion about it and answer the objections. Honestly, I think a lot of it is the client themselves sometimes are looking for a way out, for themselves to cop out, right?
Yeah.
So I don't necessarily always blame the advisor for being the skeptical one. Sometimes I just blame, it's like, this is you, this is your money. Like, bring them on. And if you really want to have an open mind about this, bring them on, let's talk. What do you think about that, Elliot?
Yeah. So while you were, I totally agree. And I've seen it so many times. I've seen people who would much rather just lose millions of dollars so they can, quote, sleep at night, right? And it's like, well, you could sleep at night just as well if you took some time to get educated. And when you think about the amount of money you're going to lose, that will be the most valuable expenditure of your time you could ever have, right? Because I believe education is what solves fear a lot of times, right?
Right.
But, I had this experience, and this kind of drives my whole mindset. It was my very first week overseas in Iraq. And it was the beginning of 2007. We had just wrapped up the trial on Saddam. And I was stationed at Forward Operating Base Union 3 in Baghdad, which is where Saddam was held and tried. And the unit I got attached to had their job was guarding him during that trial. And after the trial, we would do what's called presence patrol. So 4 Humvees, and you just drive around for hours, waiting to get blown up or something, right? so we're driving on the road, and it's 2 lanes going northbound on a freeway. And there's something called, the rear vehicle is not supposed to allow anybody to enter your convoy, which just means pass you, right? So we're in the right lane. There's 2 lanes. The left lane's open. The rear vehicle should not have let anybody pass up alongside us, but they were like asleep, not doing their job. And they allowed a up-armored Suburban, a private security contracting company, to start to pass us in that left lane. Well, I see this in my driver's side mirror. I'm new. I'm the newest guy. So the noobs get put into the highest casualty position, which is generally the lead vehicle. All right, because when you're running down the road, you're going to be the one to hit the IED, right? So I see this vehicle coming up on our left lane, and I get on my radio and I call back to Red 4, which is the call sign for the rear Humvee, and I'm yelling at them to wake up and do their job. And as I'm doing this, the Suburban passes me and pulls in front of me. And right in front of it is a on-ramp and a light pole at the base of the on-ramp. And there was a EFP buried, which is the deadliest kind of IED imaginable. It can take out an M1 Abrams battle tank. And it was buried at the base of this light pole, and it hit and wiped out this Suburban right in front of me. And I watched this thing slow to a halt as the tires melt to the road. No door ever opened. Everybody in it was dead. And what hit my head or my realization was, I am now alive, not because everybody brought their A game, not because everybody did what was right, but because people didn't do their job. And if they had brought their A game, if those guys were on point, I'd be dead. And in that moment, my entire view of the universe shifted, right? Because everybody always preaches the exact opposite. And in business, what I find is you can't depend on everybody to do what's right. You can't create a team where everyone is 100% always going to win at everything they do and do it perfect and do it right. And if that's the case, how do you move forward and operate without worrying about that kind of thing, right? How do you do enough? And I guess it just changed my whole perspective of risk. So to me, it's like, you want to sit here and go, well, what about the boogeyman tax guy? I'm like, what about him? You're not doing anything illegal. It's right in the tax code. I can lay it all out for you. And if it's been found to have been done wrong, you're going to owe the taxes you would have owed in the first place. Nobody's going to jail. right? This isn't, this isn't like a willful, wanton, like evasion of taxes where you're lying, you're
Right.
forging numbers, you're making up documents. Like,
Right.
you know what I mean? I don't know if I'm just rambling at this
No,
point.
you're
or if
exactly
this makes
right. You're
sense,
exactly
but-
right. I mean, I think the number one most expensive thing that we have is what we don't know, right? Number two is taxes. So we're hitting on literally these two things, right? So
Yeah.
if you don't know what the rules are, and you don't know what your taxes are, and you don't know that there's the worst case scenario is that you have to pay some taxes. I think the penalty is like 10% or something like that. But the thing is, if it's typically audit windows in year 2.
Yep.
Right. It happens in year 2, typically. It's year 2 to year 3, but it's year 2. And then after that, there's like a statute where it basically states they really can't audit you.
Yep.
So some people think, oh, it's not forever. You have to, if it's really to sleep at well at night, it's actually just 2 years, and they're not going to audit you in the first year. It's going to be typically year 2. So it's about that 1 year. But again, there's lifetime audit defense. But yeah, let's start diving into some strategy here, because I think that's a good mindset to have, to come with an open mindset. By the way, if you want to learn more about Elliot,
and the reason I tell those stories, right, is because when people work with me, we're not, if you'll notice, I'm in a t-shirt, right? We don't wear suits. We have dogs in our office. I had people come in once, and they brought their banker, and they brought their attorney, and they brought their CPA, and they were like offended I gave my dog like a treat at the table in the meeting, right? Well, I don't care. You're free to walk out of here, right? But somebody once told me like it helps for people to know, like, I am ex-military. I'm a little bit rough around the edges. I'm very direct. I try to keep the swearing to a minimum. But that view of risk drives me a lot. And so, but I tell clients, like, it's not my job to force you to do something. I believe money has two sides to it. It's got the math and it's got the emotion. My job is to explain the math to you. Your job is to take your biases, your emotion, and match that with the math and make a decision, right? So I can explain a deferred sales trust or oil and gas or any other strategy to somebody, and I can model for them what it's going to do for them. And I can explain the pros and the cons and all the different regulatory things around it and, all that. But they have to bring the other part of it to the table, apply it to what I'm telling them, and make a decision, right? I'm not here to force
100%.
decisions to be made.
First of all, thank you for your service. And I had some cousins all serve in Iraq, and they and I appreciate what you did for our country. So thank you for that. And I'm glad that you didn't it wasn't your turn. It wasn't you're here and you're helping people now. I like the way you put that, the math and the emotion, right? And yeah, I mean, there's like the pain of paying the tax versus the pain of, I guess, the sleep well at night or whatever it may be. But be that as it may, you're right. Education is the way, I believe, 99% of the time, to help you overcome the emotion of the fear if you take the time to sit down and go through it. And so let's start to break down some of these things, right? So
Sweet, let's do it.
Most people are familiar with 1031 exchanges, right? Selling and buying real estate, but it doesn't truly allow true diversification, doesn't allow true liquidity, and typically keeps you in debt. You have to stay in the same property, debt that you sold, you have to replace it. And it's only investment real estate, so it doesn't work for businesses, doesn't work for Bitcoin or stock. You mentioned the deferred sales trust. So what do you like about the deferred sales trust versus the 1031 exchange?
Oh, one, a lot more flexibility. Let's just put it that way, right? And like you said, it can be used for anything. And so I can capture the gross, usually, the gross dollar amount of the sale, defer the taxes on it, and then I can redeploy that in anything. I'm not stuck just trying to do it again into real estate. And so, and like you said, you can use this for things other than real estate. Businesses is the primary thing that I've done it with. I think I did it once on some Bitcoin last year. But really what it allows you to do, because I find a lot of people, even if it is real estate, they get to a point where they don't want to deal with that stuff anymore, right? And to roll over into more real estate, you're still continuing to deal with the headaches of real estate. And sometimes people don't want to do a 1031 to more real estate. They want to go to that retirement phase with the mailbox money. right? And I definitely think the deferred sales trust, it can be used for more real estate if you want, without the time restrictions and restraints on when you have to find it and buy it and close on it. But then it also, if you don't want to do real estate, it opens up the whole window to where if you want to invest in stocks, if you want to start another business, it's just like, just so much more flexibility with it, right?
100%. Yeah, I call it all the freedoms, right? You appreciate hopefully the financial freedom because you typically increase your cash on cash return. A lot of these assets have low ROEs before they're selling, 3 to 5%, and now maybe they're getting 7, 8, 9, maybe 10% cash on cash. So you're getting more cash on cash return. 2, you get location freedom. You're selling that business or that real estate. You're no longer like tied to the management or that that California, New York, wherever you might be, and you want to relocate to a different state. Next, you're getting entrepreneurial freedom. Like you might want to partner with your kids and your grandkids. You might want to do your own business. You can partner with the trust. You can give to charity or not give to charity. You can be retired or you can be passive or active and entrepreneur. Also, the income tax deferral is the piece I think a lot of people miss. You don't have to take the full interest payment from the trust. So you had a $10 million exit and a 8% note on the note, and it's producing, let's say, 8, but you're only taking 3. Well, the other 500 is deferring. Like to me, that's the most missed ROI of the deferred sales trust. That's most like an IRA in that the income tax defers as well that you don't receive. Huge. And if you map that out over a 10 or 15, 20 year time frame, it's amazing because guess what the highest tax is? Income tax, right?
Oh, absolutely. It's the absolute worst one.
If I can stack this too, right? Just Elliot, if I move out of a New York or New Jersey, Taxifornia, and I go to Missouri or go to Nevada or Texas or Florida or these more tax efficient states, guess what? I establish residency there. Then I start receiving that income from the trust. Guess where my income tax is based upon? That state.
Exactly.
Right? So I call this having a cash flow, tax flow, debt flow mindset and combining this with the DST to get time on your side to get all of these freedoms unlocked. Right? That's really the key difference.
Yeah, and that's I think you just, and I've been familiar with the DST for years, but I think you just gave the best explanation I've ever heard.
Thank you. Yeah, let's talk about estate tax a little bit here, right? Because I think this is one that also gets missed. Back to the 1031, they say, hey, swap until you drop, do this 1031 until you die, get this stepped up basis, and boom, you're tax free. Well, hold on for a second. The death tax, and you've probably seen the show Yellowstone, it's one of my favorite. Kevin Costner's on the, he's got the land, and Beth, his daughter, is saying, Dad, sell the land or they're going to kill you. He's like, daughter, we're never selling the land. She's like, but Dad, if they kill you, they're going to take the land anyway because the death tax is going to kick in. And he goes, Beth, we're never selling the land. It's like, no, this is probably the biggest highway robbery of the government you could think of. You literally pay taxes, you build it all up, you do all of the things to create all the jobs and all the things for many generations with your family, just for them to take it by brute force of 40% on top of all the taxes you pay. That's a whole nother moral argument we could have. But the point is, if you're above 30 million married or 15 million single, talk about the challenges, Elliot, here.
Well, yeah, I mean, what options are there for most people, right? So really, once you get to that level, what we start doing is moving those assets out of your estate. Mm-hmm. And that's one of the benefits with the trust is, and I think this, and I'm not sure if this is where you want me to go here with it, so you can adjust me along the way. But one of the things that the way I explain to people is you have this business or this piece of real estate, and that's the asset you own. Mm-hmm. You're exchanging that asset for a note, right? Now, underlying the note is whatever's in the trust, the deferred sales trust, right? Mm-hmm. But that note is the asset that you're passing down. And you can restructure this note every 10 years, continually deferring that income, continually keeping those assets that underlie the note out of your estate.
Close, yeah. There's yes and yes. So there's a 1.0 and a 2.0. So the regular 1.0, which is 10 million per married couple per calendar year. That's kind of the cap before there's an interest charge. The promissory note, the kids step into their shoes, still inside of the taxable estate. We have a 2.0.
Yeah, the note is. The note's inside the taxable estate.
But also the wealth. The 10. Let's say it's 10 million, right? That's still inside the taxable estate. The 2.0. We can get it outside the taxable estate. It's a different tax code. It's similar to a promissory note, but it's not. It's different. It's like a deferred payment plan.
Yeah, doesn't that one fall under annuitization rules?
Yes, and so a little more specialized and a little more proprietary. But that one is outside the taxable estate. Okay, so So let me rephrase that. So it's a different tax code. It's just a little more nuanced. It's not necessarily proprietary. I mean, it's all of this stuff, by the way, is within the tax code. You just have to have a tax team to be able to execute it. But my point is, the kids can be the beneficiaries, and then the parents live, and then they pay tax, little bit tax when they receive it. But the whole idea is now it's forever outside the taxable state. So bring this plane here. Kevin Costner, what he could have done is sell, let's say it's $1 billion of land in Montana, okay? He could have sold it while he's still alive into what's called the 2.0 version of this. It's forever outside the taxable estate, and like Beth and whatever the other, two sons' names were, one of them was like the bad son, so he maybe would be out of it, but the other son would be a part of it, right? Yeah. And they could inherit it estate tax-free, which thus eliminates the $400 million or so debt tax, save $15 million, because he was single at that point.
Yep.
That's what we're talking about here, right? And this $124 trillion wealth transfer is a tsunami the next basically 10 years, right? And so you got to have these. You got to know the rules. You got to know the math, right? You got to know the emotion. You got to know the actual consequences of inaction, and that's the big thing. And, I feel like the worst mindset is someone says, I'll let the kids take care of it. No, I mean, this is your legacy, right? Like that's the opposite of stewardship. You need to take action right now. What say you, Elliot?
Well, so I got a question for you, right? So,
yeah.
So I want to go at it from the approach of what I wrote about in my book, right? Which is that when you're working with an advisor, right? So for me, it's like I've known you for I don't know how long, and I even know, I think I don't know if I should say their names, but I know the attorneys that created this 20 years ago.
Yeah.
Because they're from Kansas City, and one of them lives out at Lake of the Ozarks, where I go down to all the time. And, so it's like clearly I have you as a tool on my tool belt, right? As a financial advisor, so that when I come across a business owner who's looking to sell something or someone looking to sell real estate, right. We even did this with somebody who lived in California, was selling their primary residence, and they were beyond the $500,000 exclusion on capital gains because the way real estate in California goes. But think of how few financial advisors are actually making use of someone such as yourself bringing you to the table when their client is going to have a significant liquidity event with a massive capital gain. And so we talked about why an individual wouldn't do it, but why aren't financial advisors doing it for people?
Great question. I think it goes back to one of your original points, and it's the team of no. And oftentimes, a lot of the financial advisors aren't independent enough, and they're with these larger big box groups that are just inside of this box, meaning what their superiors are saying they're comfortable with, and for whatever reasons, and they just either don't have the option. In fact, an advisor I worked with left a big box group for that exact reason, because they kept saying no to this strategy. So he's like, fine, I'm going to go independent, right? And I'm going to leave. And he did, and now he can. So I think that's one thing. Sometimes they're just blocked. I think the second thing would be they are not educated, kind of like back to this. They haven't seen enough deals close and understand the nuance. They're so proficient with IRAs and 401ks, right? And charitable stuff, right? That's just more the plain vanilla that they know. So I think that's just education and closed deals. That's kind of the way that we try to approach it. Is if we close enough deals, we'll get enough attention, and enough of the clients either come directly to us, and then we're like, hey, well, we've got a great advisor in Elliot. Why don't you have him manage the capital? We'll be the trustee, and great, we go, right? And now that advisor, unfortunately, is going to miss out because they don't understand the nuances. They don't know how to execute this. They don't have it. So that's the thing that I think they need to be aware of. Like, just your inaction or your lack of education is going to put you at a significant disadvantage for this $124 trillion transfer. But if you take some action, get some education, you can be a part of it as well.
Yeah, absolutely. I was on a call the other day with a client, and we were transferring assets from their other custodian, and it is one of those big box firms, and I call him Eduardo Jorge, and if you can figure out who I'm talking about from that. And while we're on hold, they literally say your Eduardo Jorge advisor is not allowed to talk to you about taxes. And I think they have 18,000 advisors around the country. That's 18,000 people that are not allowed to talk about taxes with their clients. Like,
it's like going to the doctor and he's not allowed to talk about your blood work.
Yeah. It's like
he's not allowed to talk about the flu, or he's not allowed to talk about. I mean, that's foundational to. It's your number 2 expense you're ever going to have is taxes, right?
Well,
and
what do you think is number 1?
What you don't know, remember?
Yes, and so I just wanted you to say it again because I've always heard everybody always says healthcare is your number 1 expense in retirement. I'm like, no, it isn't. It's taxes.
Yeah.
But now I need to go back and rewrite my book because I like what you. Because I always say number 1 is taxes, but I'm going to steal that from you and say what you don't know.
What you don't
number
know.
Number 2 is taxes.
Yeah,
healthcare is like
if you knew this, it wouldn't be taxes. That's the point. This is why Elliot and I are so passionate about this, because to me, it's the momentum event, right? You have a chance at this momentum event. It's probably, especially if you're a baby boomer, especially if you built it for 10,000 plus hours, 10, 20, 30 years of your real estate, your business, whatever it is you've invested in. This is an event of momentum to the government for the tax or for your family and legacy. And it's so much more than just now you're retired. To me, it's now you can multiply the freedom and impact for the most vulnerable people. The things that you believe in, right? Versus it's so much worse than even it was a year and a half ago before Doge came out. Because Doge, I think a lot of us have known the level, it's been inefficient, but do we know the level of corruption? I mean, this is the worst of the worst of the worst of what Doge has uncovered, and so you are almost like willingly like giving it to the most inefficient, corrupt, and I mean just highway robbery of taxpayers' dollars. I mean it's the worst of the worst, right? So
absolutely.
But they also, on the other hand, God bless them, they've given us tax laws that are still in the books that we can use to be the opposite. And so the stakes have never been higher. And on top of that, it's the largest wealth transfer in the history of the planet. Think about the history of the planet, Elliot, and we got an opportunity to help these people.
Oh yeah, no, it is.
All right, and there's 10,000 baby boomers turning 65 every single day, and there's 80 million baby boomers in the U.S. alone. So you combine this perfect storm and you go, whoa, and taxes at the center, but I call it the reverse Tea Party. In the next 10 years, we fought for 250 years to get to this point. What did we fight for in the beginning? We fought for the rights of the people for freedom, for taxation in an equitable way, right?
Yep.
And now, guess what? If the government gets a hold of this 124 trillion, where does our freedom go?
Well, yeah. And so let's talk about a couple things that have been done that I don't think people realize why they were done or what the impact is, right?
Yeah.
And why it's so important. To me, this is just part of why it's so important to work with an advisor who approaches everything from taxes first. Mm-hmm. And in my book, I go through a lot of different tax strategies, and I don't go in deep. Like if somebody wanted to know everything about the deferred sales trust, they just learn more about it in this conversation than you're gonna from my book. Mm-hmm. The point of the book is to make people aware of things, right? And to give them the tools to be able to find an advisor who's actually capable of incorporating all these different things to help them, right? Yep. But so we had, when I first came to this industry, 70 and a half was when RMD started. What is it today? It's 73, 74, and 75.
Oh, yeah. Mm-hmm.
Now, do you think they did that to help you?
No. They're hoping you die earlier, right?
Well, so you think about it, right?
Yeah.
If the bulk of the wealth is held by the man and he dies first, mm-hmm. you could easily you could be, as a married couple, in the 12% tax bracket, taking $100,000 to $150,000 a year out of these your retirement accounts with your Social Security. Your Social Security might even at that point only have up to 50% of it included as taxable income. Mm-hmm. You die, that all the IRA money transfers over to your spouse. She goes from the 12% tax bracket to 22. She loses a Social Security payment. And on the Social Security payment she has, she goes from 50% to 85% of it being included as taxable income.
Wow.
Now, do Do you think the government moved your RMD age to help you, or did they move it to get more of your retirement funds? Right? Then they did the same thing with the money you pass down to your kids with the Secure Act. You know, when you'd receive an inherited IRA, you still had the ability to apply that to your required minimum distribution schedule. And then with the Secure Act, they now force you to withdraw that over a 10-year period of time. Well, if you think about the average age at which someone's kid is when they pass, if I die at 80, right, my kid might be in their 50s. Well, that might be their highest potential income earning years. And now they're being forced to liquidate their inheritance from an IRA on top of their highest earning years. Again, do you think that's getting the government a higher percentage of what you left your children? Of course it is. Right? It's all designed to strip more of this wealth transfer away from the people who earned it and to the government. And I don't think very many people know about those two things.
They don't, right? We don't. Yeah, taxation is a form of theft when it's taken to these extremes for these type of things. And
Well,
no one is saying
absolutely.
that, no one is saying you shouldn't have prudent, standard things that we need, the education system, right?
But what nobody understands is all that's done at a state level anyways. Like,
right. Okay.
like I'm at a dinner in New York, and I had this actress who's pretty well known, couple major TV shows. Most people know her. And when she found out what I did for a living, she's like, got really mad. And she's like, well, how are we going to have roads and how are we going to have schools? And I just looked at him like, those are gas taxes, state property taxes. Like, what are you talking about? Like,
Right.
like that, there's no, I don't know any way to get out of property tax. And I don't know any way, and I got out of gas tax by driving a Tesla. Other than that, you're paying those taxes. Like, you're paying for the roads, you're paying for the schools.
Yeah.
What we're talking about is federal income tax.
Right.
And I don't know how anybody can make a case that an entity that's $38 trillion in the hole needs a penny from you.
Right.
But
okay,
whatever.
thank you for reminding me of that. That's exactly right. And on top of that, the death tax, that's a federal tax. There's,
It's
by
a
the way,
federal tax.
there's certain states that have additional death tax on top of it, right? Just so you, FYI.
Yeah.
But there's at least 40 for federal. But no, but what you're saying is really important. All the just the general things. And of course, you could see that with the military. Okay. But yeah, so that's a whole other thing. But the point is, we have legal ways to defer. To eliminate.
So let's talk about that, right? So I tell everybody, right, if you look at the tax code, to me it's broken up into, 4 sections. The small section is how much taxes you have to pay. And I always ask people, do you think the government wants you to defer taxes? Now, how many people answer yes to that? I don't ever get anybody that answers yes to that. I'm like, why would you think the government doesn't want you to defer taxes? Because if you'd let me make a case for why it does, you have the 401k, the 457, the 403, which is an IRA, the 403b, which is an annuity, which lets you defer taxes on an investment, the 831a, b, and c, right? Like, I just named off 6, 7 different sections of the tax code, all that let you defer taxes. If the government didn't want you deferring taxes, why are they there? So that's the bulk of the tax code in my mind, is ways that allow you to defer it. Right. Then secondly, you have ways to reduce. And the last, which is like I love oil and gas. I think it's one of the most incredible investments and tax deductions there is. And then the very last thing is like R&D credits, where you can actually get money back from the government. That's the smallest portion of it. Right. But most people don't realize that the tax code is actually a playbook on how to reduce your taxes, or defer, reduce, and get back your taxes. It's not actually on how you have to pay taxes.
Yeah, and to that point, and it's a good point, and it's a good reminder as well for all of us. Why is that? Well, guess what the rules are if you go into an IRA or you do a deferred sales trust or whatever. It's going back into the economy. It should be creating more jobs. It should be growing businesses and industry, which then creates more jobs, which creates more people to pay more taxes, right?
Yeah,
and
So why was there a mortgage interest deduction?
Yep.
To get you to buy a house.
To put you buy a
Why
house.
is there child tax credits? To get you to have kids.
Exactly.
right?
Can't force your
do you get
kids, force you
deductions?
buy a house. Yep. Mm-hmm.
Yeah, why do you have deductions for charitable donations? All these things are things the government's trying to encourage you to do.
And by the way, back to the other, like, hey, you know, the whole when the actress or whatever thinks that you're, or us who are always looking at this about the tax thing. Hey, there's a cool video on this. I think it's one of the best ones out. It's like a 5-minute video. It's called The Tale of Three Brothers. Okay, and you look it up on YouTube. I think it's The Tale of Three Brothers, and it basically breaks down three brothers that grew up on the same street. They have the same education, the same parents. They all decided to go into construction, right? Brother one decides that he's married, right? And he's gonna work 25 hours a week and his wife's gonna stay home. And they're basically gonna spend everything they make and just kind of live their life. Brother number two, he's gonna work about 40 hours a week. His wife's gonna work part-time 10 hours a week. They're gonna make, some more money, right? But they're gonna, save some and spend some. Brother number three, he and his wife are gonna work 60-hour weeks. They're gonna save most of what they make. They're gonna definitely make more, and they fast forward, and they're living on the same street, and this street has it needs to be repaved, it needs to be cleaned up, and the total cost is $30,000, Elliot, right? And they ask, and the brothers come together, and they're like, hey, how should we divide the cost? This needs to be fixed. And the third brother says, well, I think we should split it 3 ways because we're all equally, do this here, and we're all on the same street. And brother number one goes, well, what do you mean? You make 150,000 and I only make 50,000. And he goes, what does that have anything to do with it? You decided to work 25 hours a week and your wife doesn't work and you spend everything you make. My wife and I have, saved most of what we've made, and we've worked, 60-hour weeks total. And we make 150, but we have investments that are making money for us now and that are spurring economic growth. And then brother number two is somewhere in the middle, and he's like, well, I pay some tax, but I don't know. And they go, and then he goes, well, what idea do you have? And brother number one goes, well, how about this? Why don't we just follow the progressive income tax program from the U.S. government? They've laid it out for us. Brother number one, you pay for 80% of it. Brother number two, you pay for about 20% of it. Brother number three, or the first brother, I guess, and the one who makes less, you pay for nothing, right? And this is the progressive income tax thing. And it's like, I think that's a powerful place to start with some context. But just because someone makes more doesn't necessarily mean that they should have to pay for all of the things for everybody. And it gives some context for what's equitable. Anyways, what say you on that, Elliot? Any thoughts on that?
Well, yeah. So I've seen the same thing done, but with a group of guys that show up to a bar and buy beers.
Okay.
And the one thing that your story was missing is the third guy moves.
Right, he just moves. He just gets out of there.
Before they can levy the tax on them to pay for 80% of the road repairs. And now
he takes his business out, and he takes his investments out, and then there's less property tax, there's less jobs.
And now the two numbnuts that we're going to cover 0 and 20, where do they go to get the money from, right? And you see that happen in California. And New York, right?
Yeah.
And so the version of it I saw where they're buying beers is the guy that they're sticking with the bulk of the beer. He just doesn't show up one day, and now they don't know how to get their beers paid for, right? But I think your story also points to something else. And I have these friends, and I obviously won't name or whatever, but from high school, and it's like they lived their idea of a good life, right? Like they do their fun hobbies on the weekends and all this kind of stuff, right? And they're always struggling to pay their bills and do all that, right? Well, the whole time I'm in the Army, you know what I did with my leave? I'd leave Fort Hood. I'd come up to Kansas and help my brother start a business. Mm-hmm. Like I was always doing something in my time off to try and create a business, to create more income, to create more growth, right? And then somebody who's spending all their weekends at music festivals and having a good time and sitting in their garage drinking whiskey with their friends and smoking cigars, now they have a medical bill they can't pay, and guess who they come to pay it? Well, wait a minute. Like, I didn't do any of that. I spent every spare minute I had trying to build my foundation, right? And now you don't, and then you think you have a right to form a mob and come and steal from me, which is what democracy is.
Right, and then they call, so the first brother, back part of this video, calls the third brother, you're being so unbrotherly, like as if he's upset that he wants to make it even, or and then by the way, the other solution was flat tax. Fine, why don't we just do 25%, a third, like whatever you make, pay 25%. And the first brother's like, no way. Like that was so absurd to even think that they should pay anything as a percentage of their income. So that got thrown out. Oh, and by the way, the third brother got voted out 2-1, right? So these two, because the one in the middle, instead of paying 33%, he's only paying 20, right? And so the third brother gets voted out, and then they're mad. They're mad at the third brother because he's like, well, how can he be just so, selfish or whatever, unbrotherly, right?
Yeah. Well, so you're speaking to something that I think, and this is probably way off topic for whatever, but humans fall for something, and they fall for it all the time, right? And there's this great example here in Leawood, Kansas, where they put a measure forward to expand a road into like 4 lanes. They were going to seriously wind it up, right? And it got voted down. So someone who understands human psychology redid the bill, and they put it forward a second time. But this time, the bill was only to expand the road half of the distance they had the initial bill. So the people that it would impact voted no. The people it didn't impact voted yes. They got that passed. They expanded the road. Then they put forward another bill to do the other half. The people it didn't impact voted yes. The people it impacted voted no. The bill got passed. They expanded the road. This is the most perfect case study for taxes and for all of this is for some reason, nobody can ever understand that you think they're doing it to just the million or whatever, the millionaires or whatever it is. But I ran the numbers using an AI model. If you capped everybody in America's income at $500,000 and every dollar, and you didn't change behavior. So everybody that made over $500,000 was still willing to go to work, still willing to make all that money. You know how long you would fund the federal government for? Not even an entire year. With a 100% tax on all income over $500,000. Not even a year. And so the other thing that I think people don't understand about taxes, right? And I use Mitt Romney in Massachusetts single payer health care bill as an example. I ask my conservative friends all the time, why was it okay for Mitt Romney to implement single payer health care in the state of Massachusetts, but it would not be okay for him to do it at a federal level? Because this is one of the things, too, that I think that is missing in America when it comes to taxation, is that the smaller the form of government, the more control it is supposed to and allowed to have, right? An HOA can tell me what color my house can be. The city can't, the state can't, the federal government can't, right? A city can tax me at a level that the state can't. The state can tax me at a level that this federal government's not supposed to. And it's all because the bigger the government, the harder it is for me to, like, I can leave my city if I don't like its policies. I can't leave my country without leaving my country. And so there was supposed to be this different level of control with a different level of taxation. And so for a state to implement single payer, if they want to, more power to them. If I don't like it, I just leave Massachusetts. But when that's done at a federal level, I don't get a choice anymore. That's tyranny. That's dictatorship. In the midst of a bunch of people protesting no kings, the more you do at a federal level, the more tyrannical it is. Things are supposed to be done closest to the source of the problem. And that's what I love about keeping people's money in their pocket. I believe you are the person most capable of seeing a need and helping to fix it, right? And I love the parable of the Good Samaritan. And I always start with people, what was that parable not about? The guy didn't go down the road, the Samaritan, he didn't go down the road and see somebody injured and sick and needing food and clothes and shelter and medicine. So he passes by him, goes into town, forms a political party, gets elected, institutes a government program to go build a home and pay for his medical care and give him free food and free housing. And no, he didn't do that. He picked that man up, and with his own time and his own money, he cared for him and took care of him. That's what we're supposed to do. You know how that's easiest is when we get to keep our own money. When that money's not being taken from us to go fund Somali daycare centers, and we can actually see somebody in need and we can help. And it's just funny to me because I go to the kitchen downtown Kansas City. It's called Harvesters. There's only one demographic of people there, and it's all right-wing Christians. And they're giving of their time and their money to try and feed and support the hungry, right? They're not voting to steal shit from someone else and give it to other people. And so that's what I love about what I do, is I love helping people keep their money. And then I do something else that I don't know how many other people do, but I connect a lot of my clients to charity. So we support a local organization here called the I Am Foundation. The I Am Foundation works with 1,600 kids from disadvantaged communities. And we connect them to business owners to act as mentors to them. And we teach them about investing and finance and taxes and accounting. And we actually work with them to become entrepreneurs and start their own businesses. We also have a channel that pairs them up with kids in college to act as mentors for the ones that want to go the college route, right? That to me, like that's where that's like the greatest thing you can do in my mind, is help other people get to where they have the control and the freedom financially that I think everybody should have in life, right?
Amen and amen. Honestly, that was a great way to wrap it up because we're running out of time. Keep More What You've Earned is the book, everyone. Elliot Omanson is his name, and I want you to pick it up, and I want you to share this with someone it can be an inspiration to, it can be encouraging, and also challenging to, right? The freedom of America and of your family is going to be through thoughtful, strategic tax deferral and a mindset of how can you build and make a difference and make an impact. I couldn't agree with you more, Elliot. I appreciate you taking the time to spend today. For our listeners who want to get in touch with you one last time, remind them of the book and where can they find you?
It's Elliot Omanson. Keep What You've Earned. Website's Alfi, OWL, like the bird, F as in Frank, I as in investments. So Alfi, like alfinancial.com, and Elliot at alfi.com.
Awesome. And all of our listeners, I want to thank you for listening or watching another episode of the Building Billions podcast. We're also streaming on Capital Gains Tax Solutions podcast and YouTube channels. Hey, we're on this journey with you to scale from millions to billions so we can get more all the way to help MVPs, the most vulnerable people. I'm Brett Swartz. I want to encourage you to take action today. If you have a large exit, consider working with me and Elliot, right, for your large exit on different strategies, different options, and a team to help you build capital gains tax deferral and estate planning challenge that you have. Just go to capitalgainstaxsolutions.com or connect with Elliot, and we'll talk to you all real soon. Thanks so much. Bye.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swartz. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.